All right, let's dive straight into the magic kingdom of finance. We're talking Walt Disney Company, ticker DIS, of course.
Yep, it's a
We've got a whole stack of intel here, stock analysis reports, financial data, what analysts are saying, recent news.
all the good stuff.
Exactly. And our mission today, really, is to cut through it all, pull out the key info, and give you a sharp, focused picture of where Disney stock stands right now. Get you up to speed fast.
Sounds good. So, okay, looking at this report, the stock's sitting around, what, $112.36?
That's the number, yeah.
But it's interesting, the analyst's fair value estimate is actually a tad lower, $110.44. And their own price target is even lower at $103.92.
Bit of a spread there.
Yeah, and looking back over the year, it's been quite a ride from about $80 up to nearly $119. Big range.
And it's a giant, right? Market cap over $200 billion.
Oh, absolutely. Not small fry. And valuation-wise, you're looking at a forward PE of like 19.5, price to free cash flow around 18.5.
Okay. And dividends. People always ask about dividends.
Oh, right. There is one. Yields about 0.85%, which works out to $0.95 annually, paid semi-annually.
Got it. So that's the snapshot. But what's been happening lately? Let's get into their recent performance because Q2 fiscal 25 looked, well, pretty good.
Pretty good is an understatement.
Yeah.
The report flags a fantastic 20% jump in adjusted EPS year over year.
20%.
Yeah. And maybe even more importantly, they swung from a GAAP loss back to a profit. That's a big shift.
Definitely.
And it's got them feeling confident. They've actually raised their full-year adjusted EPS guidance, bumped it up 16% to $5.75.
Wow, okay.
And they're doubling down, saying they still expect double-digit earnings growth for fiscal 26 and 27. So it feels like real momentum, not just a one-off quarter.
Okay, this is where I really get interested in the experiences segment. Parks, resorts.
Yeah.
Are they basically the engine right now?
They are absolutely killing it. Experiences are showing really strong operating income growth, especially the domestic parks. And get this, record level returns on invested capital in that segment. People are definitely voting with their wallets and heading to the parks.
You see the demand.
You really do. Bookings for Walt Disney World are up 4% for Q3, 7% for Q4. Looks healthy.
So they expect that strength to continue.
Yeah, they're now saying operating income growth for experiences should be at the higher end of their 6 to 8% forecast for the full year.
And they're reinvesting heavily there too, aren't they? I saw something about huge CapEx plans.
You did. Over $30 billion planned for theme park enhancements. It's a massive number.
$30 billion. What does that signal to you?
Well, it signals they believe deeply in the long-term value and, frankly, the resilience of the physical park experience, doubling down on what makes them unique.
Makes sense. And they're expanding footprint too, right? Abu Dhabi.
Uh-huh. New park coming in Abu Dhabi. But interestingly, it's structured as a capital-efficient licensing deal with Mural Group. So less direct investment, more brand leverage.
Smart. Okay, let's pivot to the other big piece, streaming, the direct-to-consumer side. How's that battle going?
This is a huge headline from the recent quarter. The DTC segment actually hit operating profitability in Q2.
Finally, that was a big question mark for ages.
Exactly. A major milestone. It's coming from a mix of higher prices, more subscribers, and growing ad revenue on the platforms.
So subs are still growing.
Yep. Combined Disney Plus and Hulu subs increased sequentially. Disney Plus itself added, 1.4 million?
Okay.
And the strategy seems clear. Integrate Hulu content more deeply, bring in that standalone ESPN service later this year, all designed to, boost engagement and cut down on churn, make it stickier.
That integration feels key. What else is on the roadmap for streaming growth?
Well, beyond that integration, they're focusing on tech things like expanding paid sharing, which, Netflix has shown can work.
Right, cracking down on password sharing.
Basically, and improving their ad tech. Plus, they're planning to invest more in international content to appeal globally.
And that ESPN service launching in the fall. Any details?
Pricing is still TBD, they said, but the promise is it'll offer more features than the linear channels. A big play to capture cord cutters and sports fans directly.
Okay, switching gears slightly back to the traditional roots, movies, the studios. Still important in this streaming era.
Oh, absolutely. And they sound really confident, actually, about the upcoming film slate for the rest of 25 and into next year.
Calling it their strongest since 2019, I read.
That's the line, yeah. Loaded with big names, Lilo and Stitch, Pixar stuff, Marvel, Zootopia, Avatar sequels.
Heavy hitters.
Definitely. And there's a clear shift, they say, back towards quality over quantity, especially for the theatrical releases, and those key franchises like Marvel focus the resources.
Makes sense. And Lilo and Stitch becoming a top franchise, that's interesting news too.
Yeah, it indicates they can still cultivate and grow IP outside the absolute giants.
What about sports? ESPN is the core there, obviously. How's that segment doing?
So quarterly operating income took a bit of a dip, but they said that was mainly due to timing shifts and a write-off.
Okay, so maybe not indicative of the trend.
Probably not, because revenue actually grew 5%, and domestic ESPN revenue was up 7%, driven by strong advertising.
Ah, advertising. Still strong.
Seems so, especially for live sports. And looking at the full year, they're still projecting 18% operating income growth for the sports segment overall.
18%. Okay, that's solid. Now let's talk cash. Free cash flow, is it flowing?
It is. Strong free cash flow generation in Q2.
And what are they doing with it?
Two main things: plowing significant chunks back into those high return experiences.
The $30 billion we mentioned?
Part of that, yeah, and ongoing share buybacks. They repurchased $1 billion worth in Q2 alone.
$1 billion. And the target for the year?
Aiming for $3 billion total for the year. Shows confidence and returns cash to shareholders.
Okay, zooming out again. The big picture. The moat. Does Disney still have that fortress around its business?
The report gives it a wide economic moat rating, unequivocal.
And the reasoning?
It really boils down to two things. One, that treasure trove of intellectual property, iconic characters, timeless stories that drives everything.
The IP is king.
Totally. And two, the sheer scale and, frankly, dominance of the theme parks. The capital and expertise needed to replicate that. It creates massive barriers to entry. Think about Mickey Mouse. That global recognition translates into dollars across parks, merch, movies, streaming. It's immense.
Hard to compete with that legacy. But no company's perfect. What are the risks we need to keep an eye on?
Definitely a few things. Macroeconomic uncertainty is always out there, although, like we said, experiences seem pretty resilient so far.
Right.
Competition in streaming advertising is heating up. That's a factor.
Okay.
They did mention some softness in per capita spending, specifically at Shanghai Disneyland. Something to watch.
China specific?
Seems like it for now. Then there are potential wildcards, like a possible tariff on foreign films impacting the theatrical side. And there's an ongoing FCC inquiry about their DEI initiatives.
So, standard watch list stuff, plus some specific points. How are the analysts digesting all this? What's the general feeling?
I'd say cautiously positive. They're encouraged by the Q2 results, the raised guidance, the clear strategic focus.
Makes sense.
And interestingly, the average analyst price target over the last 6 months is around $130, which, compared to where the stock was when this report came out, about $102, suggests they see decent upside potential.
So, trading below where many analysts think it should be.
According to the average target, yeah.
And wrapping up, any key takeaways from the executive commentary on the earnings call? What were they emphasizing?
They really hammered home that raised guidance, the $5.75 adjusted EPS target for FY25, and sticking to that double-digit growth goal for 26 and 27.
Confidence in the outlook.
Absolutely. They talked up the record returns and experiences, acknowledged the softer spending in Shanghai, but noted attendance was still good. They stressed the Abu Dhabi park is a capital-light licensing deal, justified the big park investments with the high returns, and really positioned streaming as profitable and a core growth engine, with integration key to reducing churn.
And the movie strategy.
Quality over quantity for theatrical, definitely. And they noted the ad market, especially for live sports, is looking pretty healthy for them right now.
Okay, wow. That was a lot, but a really good distillation.
Yeah.
So, summing it up, it feels like Disney's firing on, well, maybe not all cylinders, but some very big ones. Parks and experiences look incredibly strong. Streaming has hit profitability and has a clear path.
Exactly. And there's that renewed focus on content quality for the big screen. Challenges exist, sure, macroeconomic stuff, competition, but the core assets look robust.
They're definitely leveraging those iconic brands and making some big strategic bets, particularly in experiences and integration.
For sure.
Well, there you have it, a focused deep dive into Disney. We hope this gives you, our listener, a much clearer picture of what's going on with the stock.
Yeah, hopefully useful for your own research.
Absolutely. And hey, if you did find this valuable and you want more deep dives like this, please do subscribe to our YouTube channel. And make sure you hit that notification bell.
Yep, hitting the bell means you won't miss the next one.
And it really helps support the channel and lets us keep bringing you this kind of analysis. Thanks so much for tuning in.